everyone, and welcome to this session on Chinese assets in the institutional portfolios. So we have a mix of LPs and GPs on our panel, and I'd be very interested to ask all our panelists your views on Chinese assets, which have been quite an unloved asset class, to be very honest, in the last 3 to 4 years. And then now it seems to be the darling again. So I would like to first pose this question to our panelists. Some of the issues that made Chinese assets unloved was that it was said to be uninvestable for certain reasons, primarily because of people felt that the policy environment was too uncertain to navigate. So I would like to first ask Vincent, do you feel that in terms of Chinese assets or Chinese equities, that has improved significantly?
I don't think, well, to your original assumption, so if you think about the policy uncertainty, in my mind, I don't think it has improved. I think it just, the people's sentiment towards the asset class has changed. I think it's quite interesting. I mean, this time last year, I was actually talking about, asset allocation in general. And I was already making the remark that, I think people were being a little bit too pessimistic, over China's assets. And as it turns out, that sentiment changed quite dramatically. I don't think that the playbook has changed, to be honest. It's just that, I think there's a certain aspect in terms of, excuse me. I think that now people are getting better understanding about, what the Chinese government is trying to do in terms of their policy, and governing the country and controlling different industries, and obviously seeing the market actually bounce back up, that helps. So I think the money just follow the market. I don't think the playbook has changed really, but the sentiment has.
I see. And if I may now ask Michelle. So Michelle, you've been very successful in, compared to your peers, in navigating the environment in the last couple of years. Can you tell us, has the investability dramatically changed, and is it structurally different going forward?
Okay. So I'm a China manager, so I'm on the GP side. And obviously it's been a very tough environment because everyone deemed China to be uninvestable, between 2022 and pretty much until late last year. And so I wasn't attending this conference for the last few years. So one leading indicator is that the China managers are back in the room this year at this conference, which is an indication that the narrative has changed. China is considered to be investable again, and in fact, there's significant interest to see if this is a real opportunity that allocators would like to deploy into. In terms of your question of what happened in the last few years and what the perception was, so clearly there was a very dark period after 21, right up till sort of Q4 of 2024 on the policy side, because we had sort of zero COVID and tech crackdown and different things that impacted the economy, the sentiment, and the perceived investability of the market. And that saw a significant pivot in September of 2024, when the government came out and announced a very pro-growth and pro-recovery, if you will, policies for the economy. And that was met with extreme enthusiasm. The market went up significantly that month. And thereafter, this policy has been stable and has been very focused on macroeconomic recovery, lifting up the property sector and addressing all the issues from the prior years. So I would say from a policy standpoint, investors now believe, and most of us believe, that policy is stable and is going in the right direction. I think a lot of investors would like to see more. People are expecting more support to pull the property sector out of the deterioration. We saw significant improvement between January and June of this year. So the first half of this year, we saw significant macroeconomic recovery. Unfortunately, since July, we've seen deterioration again, primarily on the property side, but also filtering into other data. So consumer sentiment has been weak throughout the year, but particularly after Q3. And leading into the year end, I think significant signs for the market will be earnings announcements from companies and other data. But I think from in policy standpoint, we've definitely moved beyond the narrative or the opinion that policy is not stable or that policy is a factor in an investment decision. I think we're firmly in the ground that policy is in the right direction. The execution might not be as smooth as desired, and the pace of stimulus might not be as aggressive as people want, but we're moving in the right direction.
Thanks, Michelle. And if I may add a follow-up question to that. So we know that what happened during the period of heightened policy uncertainty was not intentional. So Beijing did not say, let's add some drama and excitement into the stock market, but rather, I don't know if you all agree with me, it was the product of a lack of coordination. So different agencies or different parts of government not talking to each other. And I think going forward, there does seem to be a better coordination where that is concerned. But as a portfolio manager, going forward, how do you ensure yourself against possible policy or regulatory risks?
I think part of being a China manager is being following the macro and following policy. You can't avoid that. You have to read the tea leaves, you have to be reading the signals, you have to understand where policy is going and where the economy is. But at the same time, what we do at Xingtai is we are very focused on our own investment framework, and we're very focused on stock picking. So we try to pick stocks that have strong earnings and offer attractive valuation, and we try to stay focused on the fundamentals, and we try to not be focused on the momentum or the policy noise, if you will. Although we have to know it, we don't invest based on that, if you will. And so, obviously, we try to also avoid stocks that tend to be more macro-driven or tend to have more regulatory risk. We tend to focus on stocks where we believe earnings is structural and stable, and where it may not have any policy impact, even if policy would change.
Thanks, Michelle. So we'll get back to which are some of your favorite categories. But let me move on to Professor Joe Qiao. So Joe, as an LP, what are some of the lessons or takeaways that you've had with regard to investing in Chinese assets in the last few years?
Right. I actually have three views or observations to share. I will briefly talk about them. I will give some examples. Number one is the broad-based China beta is gone. Number two is that, including us, my observation is the international investors are significantly underweight in China. Number three is that investing in this market, you need to be selective on the asset class. Now let's go back to the first observation. Broad-based beta is gone. So the fundamentals, if you look at the Chinese economy and demographics, you can tell that it's experiencing a downward cycle at this moment. And I would say that for the past 20 to 30 years, we haven't seen such cycle turning. And this could be longer than what people expect, especially for people, including me, in recent memories, growing up in China and also investing in China over the years, we haven't seen this type of decline. It's broad-based, and I would say it's longer term, so we have to be prepared for that. That's a backdrop. Number 2 observation is on the underinvestment in China. It sounds a little bit contradicting to the first view, but in fact, if you look at China as an economy as a whole, represents around 20% of global GDP, 20% of global consumption, which is the second largest consumption market in the world, and also represents around 30+% of manufacturing capability. These are all hard data, and that means that as a portfolio manager, when we look at this market, we can adjusting our portfolio based on where we are in the market cycle. But what I'm seeing for international investors is significantly underweight, which means probably under 3% allocation to China. For the data I'm mentioning, around 20% versus 3% allocation. So this is a significant dislocation. Even with as China's beta is gone, there are still alpha opportunities in China. So, which leads to the third point. Investing in China these days would require a lot more work. Not like in the past 10 to 15 years where you put money in and you take advantage of the beta. Whereas now you have to be very selective. Even if we go back in time, say 15 years ago, investing in China in real estate versus investing in China in public market would yield very significantly different results. And today, that difference will be even larger. So picking the right asset class would matter a lot.
So it's all about looking for alpha. Yeah, so I would agree with you, Joe, in terms of the gradual economic slowdown of China. But I have a thesis that there will be a class of Chinese companies that do not depend on China's economy. So they are at the forefront of what they do, and they're so good that the world is their market. So, okay, going forward, let's take a forward-looking lens. So we know that Chinese stocks have recovered somewhat. Flows are coming back. Valuations are coming back. Do you think that there's more to run, or do you think Chinese stocks have just run too hot? Vincent, what do you think?
No, I'm actually quite bullish about the outlook. I think, if you think about it, the Chinese asset right now is 3 lows. So you have, I still think valuations is relatively low. Absolutely, yeah. I think we can debate on that. And then number 2 is the fundamentals. We talk about it. The fundamentals are low, but I think I would dare to say it's probably bottoming out. So gradually getting better, and for good reasons as well. Because if you look at the fundamentals. Yes, I can see the consumer slowdown. I can see in the certain sectors are actually, the economic activities in general is actually deteriorating for a bit. However, at the same time, on the back of it, if you understood exactly what happened, so you have the property market. It was one of the largest sectors of the economy. So that rebalancing is still going on, and I think it is in a very orderly manner. So I think they have actually done really well on that front. And secondly, the anti-inflation policy is actually in play. So by definition, when that happens, so that means it's taking out activities and capacity of the economy. So it will have a negative impact on the economic activities. So once we've gone through that trough, I think the way is look up. And number 3 is actually low in most people portfolio. So it's under-owned by most people. Especially, if you look at, if you talk to most of the, foreign investor, I think there is a degree of people coming back, but by and large, most of them are still sitting on the sideline. As Joe mentioned, 3% is a tiny allocation for people to consider. I think my understanding is for some of the larger U.S. endowment funds, do they want to talk about the 3% too often? Not quite yet. I don't think that conversation is there yet. But I think it will come back. So if you look at all 3 pieces, I think relatively speaking, I'm fairly confident about the outlook.
And Michelle, do you think this upturn is still sustainable?
Yes, I do. So if you look at where we are now versus 2021, we're still trading at 30+% below the peak. Valuations are still fairly cheap. Pockets have gone up a lot, but if you look at the index alone, that's still 10, 11 times. Our portfolio's 13 times PE, offering close to 30% forward EPS growth. The dynamics of what you own actually are relatively attractive compared to any global peer stats. If you look at what happened with this rally so far, also it's been concentrated in certain sectors. So we've seen healthcare stage a real comeback. That healthcare was a complete dog over the last few years. So healthcare was the first to recover in the first half of this year. We've seen, some of the tech names, the semiconductor names, the large cap TMT names rally substantially. So along this whole AI theme, that rally may take a breather. We may see a pullback with some of the technology stocks potentially, because if we see a pullback in the US technology and AI stocks, that could put that sort of rally into slower motion. And then the bank stocks have done really well recently. But if you look at the broader base market, for example, a lot of what we invest in, the consumer-driven equities, haven't actually rallied that much this year. And if you see pockets of technology also, we haven't seen a big rally either. So I would say it's been led by, the rally has been concentrated in certain pockets. It's left many equities still behind. And like what we just heard, I think the recovery is bumpy and has seen a setback in Q3. But I think long term, we are bottoming out and we're heading in the right direction. So as long as there is slightly more government intervention and stimulus going into Q4 and next year, I think we could ride through these bumps and see longer term recovery, which to support this rally going into next year.
So, Professor, so you gave quite a bleak prognosis of the long-term consumer outlook. So based on that, do you think that Chinese equities or assets have the potential to broaden out to more sectors from the narrow clusters?
I would say that maybe two fronts. On the valuation side, I will address that. I take a neutral stand on the current valuation. As we all know, that this year has been a great bull run for the Chinese market. If we compare basically from, say, last year in September to this year in September, 1 year period, the valuation, MSCI China went up from less than 10 times to now 13 times. So over 30% increase within a year. What happened in the fundamentals, underlyings, earnings from the companies did not change too much. The newest Q3 readings are not very promising. The consumption market fundamentals, real estate fundamentals, hasn't really improved. So there's no significant change in the underlyings or fundamentals, but the valuation went up more than 30%, almost 40%. That indicates to me either we were significantly wrong last year this time, or we are now significantly wrong. So I'm taking a more neutral stand. I think we both times were wrong. Last year, maybe we were too pessimistic about the future, and this year we take a too optimism views on the market. I think we are standing at the time that we should be a little careful on the risks, especially the expectations of fast recovery in the fundamentals. At the same time, we should also look on the promising side. A lot of the sectors are booming. The internal competition caused many players, outstanding players within China these days, have the opportunity to win the market and get the chance to compete in the international market. I'll give an example, because every year we all come to Singapore so often. When we go to the malls along Orchard Road, you will see more and more Chinese brands coming into the malls, consumption brands. So those are the results of Chinese brands and companies going overseas and showing their ability of operation excellence, cost control, great management, and the adoption to different cultures. I think these companies will benefit from this hyper-competitive environment and succeed in the international market.
Thanks, Joe. Yeah, so I'd be very curious to see how earnings evolve given the degree of involution, because I'm not quite sure how anti-involution works, the mechanics of it. Like, how do you just instruct companies to stop competing with each other? So maybe to wrap up, I would like to invite each of our panelists to name your hidden gems in the Chinese market. So which Chinese asset classes or categories are you most bullish on? Why don't we start with Vincent?
Sure. Okay, so we've been talking so much about the public market. And then obviously we all know, the public market, has, certain exposure to and favor in certain sectors quite a lot. I mean, the big topic right now is obviously AI. Recently I made a trip, to Hangzhou, and I've seen a lot of AI companies there, and most of them actually unlisted. So, I mean, I think, the previous panel I talked about, liquidity and obviously matter. However, for a very longer term, the fundamental, thesis and opportunities, I'm actually getting quite excited, by these, AI companies that I'm seeing in China. I mean, obviously people have been focusing about the large language, program. But you also, if you look at the robotic, machinery, everything that go beyond that, it's actually looking really interesting right now in China. However, having said that, we talk about, Chinese company potentially, they can explore the international market. I have a different thesis, As an investor, I mean, obviously, ideally, I invest global. I like to go anywhere that I find the best ideas and opportunities. But I'm conscious that, because of the geopolitical situation, some companies, may not go as far as they could potentially, because of it. So what the implication to me, it means that, I not only have to buy China, but I also have to be consciously buy something else. So potentially, if I like a certain sector or elements, I need to have both sets of portfolios to make it work. Rather than just easily find the best ideas around the globe. But that's not the case, unfortunately. So that's something I'm conscious of, and I think it's a difficulty for most of the allocators around the world.
Thanks, Vincent. Yeah, so I agree with you that the innovative capacity is there, but how do you translate it into commercial revenues or earnings is another question. Michelle, what are your favorite picks?
Well, I'm going to plug public equities because that's what we do. I think that what we really focus on, as I said before, is earnings. And I do think that, at least within the portfolio we have, which is 20 to 30 positions, these companies have really strong earnings, at least 25% looking at the next 3 years. And they are still trading at very cheap multiples. I think, back to your question of where it was a year ago, where is it now, I think it was distressed, a year plus ago. Yes. It was distressed, it was mispriced. And I think this year, yes, certain pockets have become more fully valued, maybe overvalued. That tends to be more in the big cap stock area, so because those are stocks that liquidity has flowed into. But I think there's still many pockets within both the consumption theme and the technology AI theme, if you look below the largest companies within the mid-small cap camp, where you see a lot of hidden gems still, with strong earnings and really attractive valuations.
Yep, and if you're also focused just on the public equity space, I understand that there's quite a few Chinese tech leaders that are waiting to list.
Yes, there's a very interesting pipeline of of IPOs coming up for the next 2 years as well. And I think another thing we didn't talk about in this panel was liquidity. So the big change in the Chinese market, obviously, since last year has been the liquidity profile change. That liquidity change started with domestic Chinese investors investing outside of China through the southbound connect into the Hong Kong market. That's what led to this first wave of this rally. It was actually domestic Chinese investor-led. Then we had international flows follow on. But as we've all said on this panel, China is so underinvested from a global allocators perspective. We're still at this minuscule level of allocation. Same goes for domestically. Domestic investors, domestic ordinary citizens are so underinvested in equity markets. They've always made money through property. Their property investment is showing a negative return on their balance sheet, and they have tons of savings, and it needs to be deployed somewhere. And the most logical step we would want to see is obviously that it would be deployed into equities, over the future years. So both these factors would argue for more liquidity coming into China, both from domestic sources and international allocators, which should, sustain what we're seeing here.
Yep. So there's a lot of pent-up capital sitting on the sidelines still. Yeah. And I would agree that I think there's a lot of deserving debutantes waiting in the wings to be listed. So as Vincent just mentioned, in Hangzhou, we see a lot of prominent tech leaders, like in Hangzhou, the 6 little dragons, some of which are preparing to list. And I understand that Hangzhou actually also has apparently 600 dragon eggs waiting to hatch. So it's a hotbed of innovative activity. So Professor, what hidden gems do you see in the near future?
Right. So just now, I gave an example of consumption markets going overseas. I think that's a big theme and trend because the Chinese companies or brands who survive the severe competition internally, when they go overseas, they do have a very strong entry barrier and operating capabilities. Number 2 is any companies or services utilizing Chinese complete supply chain and taking the cost advantage. I've seen a lot of some consumer brands does that, and some innovative technology companies does that. They outsource their manufacturing capabilities in China and then trying to utilize this supply chain advantage and go overseas. Number 3 is more on policy-driven areas. Back to the liquidity, right? In China, a lot of the liquidity is driven by the policies. And when you look at the policy-driven areas in the past few years, those are the areas you see most transactions going on, and valuations can maintain at the right level.
Yep. Thanks everyone. So with that, our time is up. And I think you get a pretty good consensus, varying levels of optimism in the Chinese market. Thank you, Michelle. Thank you, gentlemen.
Thank you,
everyone.
Thanks, everyone.